Its profits grew nearly 4 times. Its owners waited 25 years. March 2000. One company is worth more than every other company on earth, more than $550 billion. On the Monday, one share closed at $80.06. It has never had a better day. The company was Cisco. It made the boxes the internet runs through, routers, switches, unglamorous gray metal. And the business was real. This is the part that should bother you. Cisco kept growing, more sales, more profit. It's a far bigger business today than it was that day. The company was fine, the shareholders were not. It took 25 years and 8 months for that price to come back. Nothing went wrong with the company. Something went wrong with the price people paid for it. One number said the price was fine. It's the most quoted number in investing. Hardly anyone checks what's inside it. Price to earnings. P over E. Forget the letters for a minute. I'll give you the whole thing with a coffee cart. There's a cart on your street. It clears $10,000 a year. That's the earnings, the profit, after everything. The owner wants out. She asks $50,000 for it. $50,000 to buy it. $10,000 a year coming back. You're paying 5 years of profit. That's the P over E. It's 5. That is genuinely the whole idea. How many years of today's profit am I paying for this thing? That's the only question this number answers. Everything else people hang on it is decoration. Now a different seller wants $500,000 for the identical cart. That's 50 years of profit. Same cart, same coffee, same $10,000 a year. Nothing about the business changed, only the price did. So the number is never about the company on its own. It's about the company and what you paid. Here's the move almost nobody makes. Turn the ratio upside down. 1 divided by 5 is 20%. The 5-year cart pays you $20 a year for every 100 you put in. 1 divided by 50 is 2%. $2 a year for the same 100. That's the earnings yield. Your share of the profit as a percent of what you paid. It is the same number wearing honest clothes. This is investor school. No finance background needed. And by the end of this, you'll run this sum on a real company's own report yourself. So let's do it on Cisco in its best year, using its own filed accounts. Cisco's annual report for the year that ended in July 2000. Every number I'm about to use is on 2 pages of it. Profit for the year? $2.67 billion. Income statement, the bottom line, called net income. Now split that across all the shares, 36 cents of profit per share. Same statement, the line called diluted earnings per share. Diluted just means they counted every share that could exist. Not only the ones that do, it's the tougher of the 2 numbers, so use it. And the price, $80.06, the record close. The company doesn't set that one, the market does. $80.06 divided by 36 cents. That's it, that's the sum. 222. 222 years of profit for 1 share of a company having the best year of its life. And I've been kind to it. I used the full year's profit on the day nobody had that yet. Now flip it the way we flipped the card. 1 divided by 222. 45 cents. That is what $100 of the hottest company on earth actually earned that year. 45 cents a year. Hold on to that because it does the work of this whole episode. Same Monday, same money. You could have lent it to the American government for 10 years instead. The rate that day was 6.21%. $6.21 a year on every 100 backed by the United States government, or 45 cents a year from the most exciting company in the world. Read that again. The dull safe option paid you about 13 times more that morning in cash. So nobody buying Cisco that day was buying its profits. There weren't enough of them to matter. They were buying the profits it hadn't made yet. That's what a high P over E really is. It's a bill for growth that hasn't happened yet, which raises the fair question. What if the growth does happen? At Cisco it did. In the year to July 2025, Cisco made $10.18 billion. $2.67 billion up to $10.18, nearly 4 times bigger. Per share, it's better still. 36 cents up to $2.55. Run that division and it's about 7 times the profit on every share. The company delivered completely, and the share price first closed above $80.06 on the 10th of December 2025. 25 years, 8 months, 13 days, a whole working life to get back to where you started. There's a smaller trap folded inside that and it's worth 20 seconds. The share price beat its old record. The company's total value still hasn't. In 2000, there were about 7 billion Cisco shares. Today, there are about 4 billion. It bought its own shares back for 25 years. Fewer shares, so more profit lands on each one. Per share numbers can rise while the whole company stands still. Remember that. Right, let's run the exact same sum on the company everybody actually wants to ask about. NVIDIA. Its last full year ended in January 2026. Profit $120 billion. Per share $4.90. Same line, same place. Diluted earnings per share. The share closed at $225.16 on the 14th of August, 2026. 225.16 divided by 490, about 46 years of profit. Flip it and you're earning a bit over 2% a year. And unlike 2000, the growth here is already filed. 17 cents a share, then $1.19, then $2.94, then $4.90. 4 years. So no, I'm not going to stand here and tell you Nvidia is Cisco. 46 is not 222. That difference is the entire point of learning this. But there's a second trap, and it's the one that actually caught people in 2000. There are two versions of this number, and they get quoted with the same 3 letters. The first uses profit the company has already made and already filed. That's called trailing. It's history. You can check it. The second uses next year's profit, which hasn't happened. It's somebody's estimate. And here's the trick. Keep the price the same, divide by a bigger guess, and the stock looks cheaper. Nothing about the company changed. Somebody just typed a bigger number. In 2000, the estimates for Cisco's next year were enormous. That's what made 222 look survivable. Here's what actually came. In the year to July 2001, Cisco lost money. $1.01 billion of loss. It had built gear nobody wanted. In 1 quarter, it wrote off $2.25 billion of unsold stock. So the forward number people were quoting was dividing by profit that never arrived. You can't divide by a guess and call the answer a fact. A forward P over E is a P over E with somebody's opinion in the bottom half. Ask whose? Ask when they last changed it. That's trap 2. Trap 3 is worse because it hides in the trailing number as well. Even if filed profit is a choice, companies reported more than one way in the same document on the same page. Cisco again that lost year. Its accounts show a loss of $1.01 billion. In the same accounts, there's a second profit of $3.09 billion. Same year, same company, $4.1 billion apart, both audited, both legal. The second one just leaves out the write-off and a pile of other one-time costs. If that's useful, subscribe. We're a brand new channel, and subscribing is how we know you want the rest of this school. Because this isn't a museum problem, it's in filings from this month and it runs in both directions. Nike's last year, $2.10 of profit per share. 52 cents of that came back from customs, a tariff refund. Real money, fully legal, and nothing at all to do with selling shoes. Take it out, and Nike earned $1.58 from shoes. At the same share price, 19 years of profit turns into 26. It cuts the other way too. Nvidia's most recent quarter shows $58.3 billion of profit. $13.4 billion of that was shares it owns in other listed companies going up in value. Before tax, nobody sold anything. A real gain and not chips. Nvidia prints the calmer version a few lines above. Operating income $53.5 billion. That's the business itself. Read that line and the picture settles down. So 3 checks. You can run all 3 tonight on any company you like in about 10 minutes. 1. Flip it. 1 divided by the P over E gives you the earnings yield. Then look up what a 10-year government bond pays today. If the bond pays more, you're betting the whole thing on growth. That's allowed. Just know that's the bet you made. 2. Ask which E it is. Trailing out of a filed report or forward out of an estimate. If nobody will tell you, treat it as forward. 3. Open the income statement and hunt for one-time items, a refund, a write-off, a gain on shares. Take them out and do the sum again. Here's where it all lands. The people who bought Cisco in 2000 were right about the company and still lost 25 years. Being right about a business and being right about its price are 2 different jobs. This number is the only place those 2 jobs meet. That's why everybody quotes it. That's why hardly anybody checks it. One last thing. Run it on Cisco itself tonight. $2.55 of profit a share, and look up what 1 share costs today. You might be surprised who's expensive now. Numbers don't lie. People make the numbers. This is education, not financial advice, and every figure here came out of the company's own filings. So which number should we dust for prints next?